Today we're looking at how to actually research an ETF to buy in the first place. We talk about ETFs a lot on this channel, and I figured I may as well talk about some steps that you can use to research ETFs on your own. Hey guys, my name is Fyzee and this channel is about finance and investing. Before we begin, as usual, this video is not financial advice. I'm not a financial advisor. Please do some research on your own too. These are simply some of the things that I use to research ETFs. You may have different steps, so if you do leave it down in the comment section so other people can learn as well. Let's jump into it. So when it comes to ETFs, you first have to understand what they actually mean, right? So an ETF basically represents a basket of shares that it tracks over time. Now, if you're a relatively beginner investor, you might not know that there's actually more ETFs out there in the world than just those passive types of ETFs. We've got stuff like active ETFs, leveraged ETFs, thematic, income, ethical, commodity ETFs, currency ETFs as well. So as you can see, there's a lot going on there, and we'll dive into these in just a second. But with all these ETFs, researching the fundamentals of them is very important, and it's a good place to begin. Now, by fundamentals, I mean stuff like the fees of the ETF, the geography that it tracks, its holdings, performance, dividends, and lots of other little things as well. So as a very simple example, let's have a look at A200, which is a very popular ETF to track the ASX 200 index, and we can see some high level facts like the fees, which are 0.07%. It's very minimal. The geography of the ETF is of course Australian because it's tracking the Australian index. And the holdings for the ETF are mostly financials and materials at about 50% combined. And the performance of the ETF is going to be mostly in line with the ASX 200 index. So since it's a passive ETF, we're not going to worry about this too much. The dividend frequency of the ETF is quarterly, which means that it pays out a dividend 4 times a year. And the DRP option is also available, which is basically the dividend reinvestment plan, and the net assets are 1.6 billion. So these are essentially the fundamentals of the ETF, which I like to call. So looking at this example ETF, you need to analyze and research these fundamentals to ensure that it's something that you actually understand first of all, and it's something that you're comfortable with. So in the case of A200, the fees of 0.07% turns out to be around $7 per $10,000 invested, which is very little in my opinion. It's probably one of the lowest fees out there for an Australian-based ETF, the one that tracks the Aussie market, so I think it's pretty good in that respect. The geography is 100% in Australia, which is fine if we're trying to, of course, invest in Australia, so that's all good. But looking at the holdings, however, here we have to make a decision, right? Are you happy with having 50% of your holdings geared towards banks and miners? Does it align with your values? Of course, with miners, they are not looked favorably upon when it comes to, ethical side of things. They've been in hot water recently as well with all this mining going on. And generally speaking, people don't really like the big banks either. So are you happy or are you okay with investing in 50% towards those companies? Now look, there's no real right or wrong answer to this. It just depends on what your view is and what your values are, I suppose. The other thing that you have to analyze is the performance of the ETF. Now, look, generally speaking, since this is a passive ETF, the performance is going to be more or less similar to the ASX 200 index, so we're not going to worry about this too much. And when it comes to dividends, you might not be worried about that too much either. And the net assets, basically the higher this number, it means that there's more interest garnering in this fund, so it's a good sign. But generally speaking, it is not too big of a thing to consider when it comes to just those broad market ETFs. So that is just one example of the stuff that you need to consider when looking at an ETF. Once again, I'm not endorsing for you guys to buy A200. It is just an example ETF, some stuff that you need to look out for. So let's say that you go out there and you do the research and you find that A200 is a good buy because you've done the research, you like that the fees are very little, it tracks the Aussie market, and you're happy with it. But you also need to consider the opportunity cost of buying this ETF. Now, what I mean is, if you buy this ETF, what are some of the other ETFs that you might be missing out on if you just buy this ETF? Meaning, are there any other alternative ETFs out there that track the same thing but could be much better instead? So that's where you need to start looking at other similar comparables to A200 as an example, like VAS, which tracks the ASX 300 market, or IOZ, which tracks again the A200 market, or MVW, which basically has an equal weighting towards the Aussie market. And with MVW, as you can see, since it has an equal weighting, the sectors more or less look pretty even. The focus on materials and financials is still strong, however, it is to a lesser extent. It's less than 40%, where the weighting towards IT is slightly more. So depending on your research, you also want to have a look at those close comparables to A200 or whichever said ETF. Now, I'm not saying which ETF is better or worse. I'm just saying to have a quick look at those close comparables and do the research and find out which ETF is the best one out of the ones that you've chosen. Now, you might say to yourself, I like VAS because it's giving me access to the ASX 300 market. It has an extra 100 companies and I like VAS, so I'm going to buy it. But then you also might say, I love A200 because it's the lowest cost fund in Australia. The fees are so minimal. So what I'm going to do is I'm going to buy 50% of VAS and I'm also going to buy 50% of A200 to get the best of both worlds. Now, if you actually end up doing what I just said, then you will also need to consider ETF overlap or double dipping as they call it. Basically, ETF overlap happens when you have 2 or more ETFs in your portfolio that basically track the same thing or have the same underlying holdings, and it basically means that your portfolio is less diversified because you're double dipping on those holdings. Since you have more of an allocation towards those underlying companies, the risk of your portfolio is going to increase, and consequently the volatility of the portfolio is going to increase as well, which is basically a fancy way of saying the portfolio is going to have very wild upswings and downswings over time. So because of this, you might want to consider only picking just one of these ETFs. Now look, if you need some help deciding between VAS or A200 or MVW or IOZ, all these, ASX 200, 300 ETFs, I've done a full comparison, a full kind of side-by-side comparison, comparing the holdings, the fees, the assets, every main fundamental in that ETF. So if you want, there should be a link somewhere here. That video will basically help you to decide which ETF you want to buy, and there's a link in description as well. Now, one thing I want to say when it comes to ETF overlap is the fact that, in my opinion, ETF overlapping is not always bad. For example, if you have a view that Australian technology is going to do pretty well in the future and you're pretty bullish on Aussie tech, you think in the next 10, 20, 30 years it's going to be revolutionary, you might still want to buy a standard ASX 200 ETF like A200, but then you also might put a smaller position in an ETF called ASX A-Tech, right? This basically tracks the top tech companies on the Aussie market, right? So what you're basically doing is that you're double dipping, right? So the companies on A-Tech are the same companies in ASX 200. The risk of your portfolio is increasing and you're more susceptible to volatility. However, you're doing this very intentionally. You're doing this with the thesis of the technology sector doing pretty well. So basically the risk of your portfolio is going to increase for sure and you're going to have more volatility. However, if you've done the research and what you believe actually tends to happen in the future, then more than likely your portfolio is going to outperform in the future. Therefore, that's why I say that ETF overlap is not bad in every single case. It depends on your intention and depends on your thesis and research and whatnot. So let's say that you finally found your ASX ETF and then you say to yourself, you know what, I want to start investing internationally. I want to start investing in the American market. What can I do? Well, the thing is, the process is pretty much similar, right? So what you do is you try to find a broad market ETF that tracks the US market, like for example, ASX IVV. Then what you do is you analyze the ETF, you look at the fundamentals and make sure that you understand them and that you're comfortable with it. And then you start to look at similar comparables to IVV, like for example, ASX VTS, which is a pretty popular ETF, ASX SPY, and then you start to look at those ETFs, compare them, and then make your decision. Now, obviously, you're going to want to make sure that the ETF that you choose has the lowest fees and that you're happy with the allocation towards the assets in the ETF. Now, personally, a mistake that I made when I first got started with investing into the American market back in like 2018 was I instantly bought the ETF, which was ASX SPY. Now, this ETF tracks the S&P 500. However, I could have actually done some more research and I could have bought IVV instead. SPY basically has a little bit more in fees. It's not a lot, but if you have an option that charges you less fees, you may as well choose that option. So if I did just a tiny bit more research, I should have bought IVV instead. So that's why you want to look at close comparables to make sure that you're getting the best deal. Now, similarly, you can also research all-in-one ETFs, as I like to call them, like VDHG, DHHF, and some other similar ETFs. These ETFs basically invest in the whole world. So you've got, a little bit proportion into bonds, the American market, international market, and the Aussie market as well. So it's a pretty good diversified option if you want to research into it. Obviously not financial advice, but that's how you would usually go into it if you're looking to buy into ETFs. Basically find close comparables and go from there. Now let's take a step away from broad market ETFs and talk about ethical ETFs, active ETFs, and thematic ETFs. Now generally with ETFs like this, the fees for them are going to be a bit higher because these require more work from the portfolio manager, because the managers are actively looking for companies, they're researching them, and they're actively buying and selling companies as they wish based on the investment objective. So since it requires more work, more research, the fees are going to be higher as well. So how do you go about researching these? Now personally, one way that I go about researching these is that I try to match them up with a benchmark, basically compare them to a similar benchmark like the ASX 200 or the S&P 500, just to see how the performance of these ETFs have been. So for example, if you're looking to buy an ethical ETF like ASX Fair basically invests in the top ethical companies on the ASX market. So you want to try to compare this ETF to ASX 200 and basically see what the results are like. You want to at least see if ASX Fair is outperforming A200, or if it's not outperforming, is it at least matching the benchmark? These two are pretty important to compare because it's pretty much opportunity cost, right? If you buy into ASX Fair and A200, you're going to have significant overlap. So most likely you're going to be choosing one or the other. So you want to make sure that you understand what the risks and what the performance has been in the past. Now, of course, past performance does not guarantee future performance, but at least it's a reference point and you can actually figure out if ASX Fair is worth investing in. If this ETF is underperforming for the last couple of years, you want to try to understand and maybe think about whether it is still worth investing into just to be ethical. Of course, it's up to you, but just keep that in mind. Now, similarly, if you're trying to invest in a thematic ETF like ASX ACDC, this ETF tracks the battery technology and the lithium market around the world. You want to at least research and make sure that this industry is going to at least grow in the future. And you want to start asking questions like, what is the scope? Where is the world heading? Where is this trend heading? Is this trend actually going to grow? So you want to make sure that you do this sort of research because it's going to dictate whether or not the underlying companies are going to grow with the trend. Now with lithium batteries, we can kind of see the trend forming. We can see the research as well, obviously with electric cars requiring those lithium batteries, and batteries are improving as well. Obviously, we need them for smartphones and smart homes and stuff like that. So we can kind of see the trend is growing, but for other thematic ETFs, you want to make sure that you're doing this sort of research. And just for comparison, you might also want to match this ETF against a benchmark like the ASX 200 or ASX 300 or even the S&P 500 just to see the rough return. Now, of course, in the case of ACDC, it's actually done pretty well over the past kind of couple of years. So yeah, it's done pretty well. Now, if you're interested in a thematic ETF like ACDC, I've actually done a full video, basically a full review going into the actual trend, what the ETF tracks, and some growth factors for the ETF. I've done a full video right here. You can check it out. This video is pretty informative. I hope it'll help you. Now, lastly, let's talk about some things you should consider before investing in ETFs. So the number one thing that you should probably think about is your risk profile and your risk appetite, right? So broad market ETFs, generally speaking, are going to be lower risk than other ETFs like thematic ETFs and active ETFs, because broad market ETFs have been proven to work over time. Whereas these active ETFs are mostly new and they're tracking a trend. They're basically tracking a specific sector of the world. So you want to make sure that at least the trend is going to grow, and you want to kind of decide whether or not you want your full portfolio to be index-based ETFs or thematic ETFs or active ETFs. You want to make sure that whatever combination you choose is in line with your risk appetite, because if you're not comfortable with a 100% portfolio in thematic ETFs, it's not really worth doing, and it might be best to just stick with the passive approach and buying into those passive types of ETFs. And with ETFs like the actively managed ETFs, yes, they have a potential to outperform the overall market, but they do come with higher fees and management fees as well, outperformance fees, and obviously higher risk. So you want to make sure that all of this is accounted for. Secondly, if you're having overlap and you're double dipping in your portfolio with similar ETFs, is it worth doing so? Are you doing this on purpose? Are you deliberately having overlap to get that concentrated exposure? Or is it something that you can remove if you wanted to? And lastly, how are you going to buy these ETFs? Can you choose a broker that offers these ETFs for free? Or are you happy to pay the brokerage cost to buy into these ETFs? After all, these brokerage fees do eat up into our returns over time. A simple example that I can give you is that all American ETFs on the Stake platform are completely brokerage fee. Stake basically charges you an FX fee, whereas if you bought the exact same ETFs using, let's say, ComSec will charge you the FX fee, plus they will also charge you the brokerage fee. So you are paying two sets of fees to buy into the same ETF. So you want to make sure to look into options where you can avoid the fees if possible. Similarly, some ETFs are free on Perla, which is what I use. All ETFs are free on Superhero, but they're not Chess sponsored. So you want to make sure that you're looking into these things. Each broker has their pros and cons, so make sure to do the research on brokers as well. Now guys, if you are interested in using Perla or Stake, there's a link in description where you can get either a free stock or some free trades with these platforms. Go check it out if you're interested. So hopefully by now you understand the general gist of how to research ETFs. As of now, there's literally hundreds of ETFs out there, possibly even thousands globally. So hopefully this can be a good guide for you guys to start from. Now, if you're still confused as to which ETFs you should look into when it comes to investing in the Aussie market and the American market, I've done two videos right here. This video basically has a side-by-side comparison of all the broad market Aussie ETFs out there, and this video compares some good ETFs to look into to invest in the American market. Hope these two videos help, and guys, thank you so much for watching. Please like and subscribe, and I'll see you in the next one. Bye now. This video basically compares all the